Now, furthermore, we can actually decompose our Sharpe ratio now into two parts, sort of the active portfolio risk and the market index portfolio, or passive portfolio. How do we do that? Well, essentially what we can say is that the Sharpe ratio that we have calculated, well, specifically the Sharpe ratio square, is going to be the square of the market portfolio's Sharpe ratio. Remember, its expected return over its standard deviation squared, plus the alpha of the portfolio divided by the sort of firm-specific or idiosyncratic risk of the portfolio. In other words, the standard deviation of the residuals. And again, this square. So the information ratio is essentially this latter part. And without the square term, the alpha that our securities provide relative to the additional firm-specific risk that our securities introduce relative to what the market portfolio would have. So the information ratio then essentially represents the contribution to the active to the portfolio in terms of active risk, the alpha, relative to the residual standard deviation. I guess the active risk is the residual standard deviation, the active return is the alpha. So if we did go through that step of actually conducting firm-specific security analysis, and we didn't compute those weights simply sort of as a way to maximize the Sharpe ratio of the portfolio, but actually pick the weights optimally consistent with our firm-specific forecasts, then of course we would have an alpha that is different from 0, and if we did a good job, then our information ratio would be higher. And of course, if we did a worse job and we underperformed the passive sort of market Sharpe ratio, our alpha would be negative. So this use of the information ratio essentially lets us diagnose then the quality of our active stock picking, if we choose to engage in it, relative to the Sharpe ratio that we would get if we just essentially followed the market portfolio. Now, how do we actually do if we follow this approach, which at least does seem much simpler in implementation, than if we actually had followed the perhaps more methodologically rigorous portfolio theory approach, which, remember, doesn't rely on the simplifying assumption of a single macroeconomic index and the fact that we can proxy for the macro index with a commonly used but relatively narrow portfolio of, let's say, the S&P 500. Well, if we carry out a data exercise similar to what Bodekane and Marcus do, then we actually can see that we come fairly close. In some cases, the efficient frontier from the Markowitz approach is better than the efficient frontier from the index model, but in some cases the index model is actually potentially better than the efficient frontier we get using the covariance model. But of course both are models, so really all that this is saying is that the two results are different. We don't really know which one is absolutely right. But the good news is that we also see that the two are fairly close. So in other words, this simplifying assumption of the single index model that saves us a tremendous amount of headache of not having to estimate, for the S&P 500, let's say, about 125,000 parameters, and instead only having to estimate essentially 500 alphas, 500 betas, 500 variances of model residuals, and the expected return and the expected variance of whatever the index model portfolio we want to use. We can see that this assumption actually gets us a substantial benefit in that reduction of parameter estimates, but doesn't cost us very much because the efficient frontier we estimate can actually come out looking quite similar. If we look at sort of the portfolios that we actually get from following the single index model or the covariance model, we can actually see that the optimal portfolios have similar means, similar standard deviations, similar Sharpe ratios, and the global minimum variance portfolios, which, remember, we would estimate by just trying to minimize portfolio variance in terms of total risk, which we can also do in single index model world because we have that expression for portfolio variance. We see that the global minimum variance portfolios are also similar. Their Sharpe ratios are similar. The weights in this data exercise are similar. Well, maybe with some differences, but on the whole, it actually looks like we get a very similar looking output using this different single index model approach as we would using the portfolio theory approach, but at a far lower cost in terms of actually implementing a model and estimating all of the required parameters. So then, is the index model actually inferior to the full variance, covariance, Markowitzian portfolio theory model? Well, remember, it's a descriptive model. It just sort of relies on this fact that we observe that risk assets move in relation to the market portfolio, and that we can proxy for the market portfolio using something like a large enough market index. But it does seem that this model is actually not inferior in terms of output. So while the Markowitz model is sort of much more mathematically well-grounded and doesn't make simplifying assumptions, or it may make different ones in terms of investors only caring about mean and variance, but at bottom, it's a much more sort of developed mathematical theoretical model. We actually see that the single index model is superior in the sense that it doesn't actually require the model risk or estimation risk of actually producing all the variance covariance terms necessary for the portfolio theory Markowitz approach to the optimal portfolio construction. And this is actually a meaningful impact because once you estimate millions of variances and covariances, you really do end up building up substantial model risk, as it can be called in data science. In other words, the uncertainty in your output simply induced by noise in the parameters that you are estimating. Because the cumulative errors in each of these variances and covariances then affect your optimal portfolio solution. And once you have enough of them, then you can actually end up with a quote-unquote optimal portfolio from Markowitz that is actually worse than the, albeit mathematically less rigorous, but close enough approximation that you would get from the single index model. So the single index model is, by its simple nature, very practical. And the other nice aspect of it is that it actually can sort of separate out or decentralize your macro analysis. In other words, your forecast for the market portfolio expected return and variance from your security-specific alpha and firm-specific error term, those two components of the information ratio. So the last item that remains then is simply just sort of to discuss how we can actually implement this, or how it's often done in the industry. So first of all, it's commonly done using the last 60 months or 5 years of price data at the monthly frequency. We would often use the S&P 500 as the proxy for the macroeconomic risk factor, the market portfolio. Again, remember, the S&P 500 is not the market, far from it, but it is close enough for our purposes. We actually will compute total returns for individual assets, as well as for the market portfolio, ignoring dividends, a simplifying assumption again. And we will estimate an index model without worrying about adjusting for excess returns. In other words, we don't really bother with what the risk-free rate is, and we essentially just say that the return on the risk asset is alpha plus beta times the return on the S&P 500 total without dividends. And then we again get that residual, which will then be our estimate of the firm-specific risk. Now, when we estimate that beta from this regression using 60 months of data with sort of total raw returns from our risk asset and the S&P 500, we're going to get some beta, but we shouldn't necessarily rely on our point estimate too much. So one thing that's commonly done in the industry is essentially sort of a shrinking of the average beta, of the beta that you estimate to the average beta. Now remember, the portfolio of the market is essentially made up of all assets, and of course the beta of the market portfolio is by definition then 1. So that means the average beta for all assets is also 1. So if you had to forecast a beta for any arbitrary asset, you know, your best guess, knowing nothing about that asset, should probably be 1. So there's sort of an argument to be made for shrinking your beta estimate toward 1. In other words, especially as firms become more mature, as they sort of become more typical, as it were, their betas are going to get closer to 1, and because your beta is estimated with noise, but you know that the average beta is going to be 1 with certainty, that sort of gives you more justification for estimating your beta with, or pushing that estimate closer to 1. Now, how much you want to weight these two, your actual point estimate of beta versus your sort of average beta of 1, well, that depends. Well, you can say that, for example, the adjusted beta is going to be some weight times your regression beta, we'll call that beta hat, plus 1 minus that weight times your sort of long-run average beta of 1. And one common weighting, though there's not very much scientific about it, is to use 2/3 for your regression estimate and 1/3 for your long-run average of 1. But that's just another sort of simplifying assumption. But the sort of point behind it is that even though we're estimating fewer parameters, now we're still estimating n betas, each of them with noise, and therefore it might make sense to sort of shrink our estimates closer to what the long-run historical average for beta is, which of course is 1. Now, because we see this sort of transition dynamic in betas, in other words, they naturally drift toward 1, another way to actually estimate your beta would literally be to build a forecasting model, where you could say that your future beta is going to be essentially a regression model itself. You're going to try to predict future beta with some coefficient of the intercept alpha plus, let's say, a beta, if you will, of your historical beta. So in other words, you'll take your historical observations of beta and your observations of beta in the next period, whether the next year or the next 5 years, and you'll actually try to create a linear model that predicts your historical beta or your future betas based on your past betas. And indeed, what practitioners actually have done is you can actually then also add some controls. So you can have a coefficient on your historical beta, but then you can also have another coefficient, we'll call it beta 2, on some firm characteristic. And in fact, you can use multiple firm characteristics that may matter. And one famous institutional manager, Barra, has actually looked at sort of in detail what characteristics might actually improve the predictability of future beta. And from that, you can actually see what your quality of fit is for each maybe firm or perhaps each sector. And that will let you adjust beta in a perhaps even better way than shrinking it toward 1. And indeed, if you sort of do this beta forecasting approach that Barra pioneered, you'll actually see that the betas for some sectors are systematically lower than what your forecasting model might otherwise imply, and some are actually higher than what your forecasting model might imply. So that may mean that you simply need to make your sort of intercept term in the regression model sector-specific. But generally, the firm characteristics that one might use in forecasting beta are things like firm size, debt ratio, the variance of earnings and cash flows, the growth in EPS, the dividend yield, of course, historical betas, and these sector-specific adjustment factors. All of this will let you build a more sophisticated beta forecasting model should you want one. So in other words, you don't necessarily just have to take your Excel output. You can either shrink it toward 1 as a simple approach, or you can actually conduct a more sophisticated predictive regression for beta using this firm characteristic, historical beta, industry-specific adjustment factor approach. So this is sort of the power and the promise of the index model. It's a simple descriptive model. It isn't necessarily grounded in very much theory in terms of investor preferences, but it seems to give us results that are actually similar to, and in many ways superior to, the much more sort of theoretically sound portfolio theory approach. The fact that this indeed is the approach most often used by practitioners to construct optimal portfolios suggests that despite the simplifying assumptions, or indeed because of them, this is actually a very practicable solution to the optimal portfolio choice problem. Thanks for listening.